Hi, I'm Pete Andresen with Andresen and Associates, and it's December 2024, and it's time for annual predictions. At least that's what people are asking me. What do you predict? Before I do that, let's savor a little bit of a moment here. Take a look at this graph. This is from July 1st, 1997 to December 2nd, 2024, so a few weeks ago. What a marvel the American capitalist system is if you participate in it. The challenge is to participate in it. But look at the returns here. Look at these stunning returns. Across those decades, across all the turbulence, a war, two wars, a virus pandemic. Look at the returns. There's some things to notice here. Number one, it sure does make money, doesn't it? Investing sure does make money. Tech makes money. But the top investment in this multi-decade graph is not the S&P 500. As you can see, many of our holdings that you recognize from your own account are beating the S&P 500 over this long term. So, that's the first comment. The second comment, it sure can be a rough ride. I mean, why don't we just all put it into tech and ride the tiger? Take a look at this graph. This is from the high water mark of the tech bubble through 2002. And look at that. It's terrible losses. And you can see in this why we diversify. And you can see why we have bonds. Bonds really don't make a lot of money. In fact, they cost us big a couple of years back when the Fed raised interest rates. But look at what happens. The bond funds provide the capital to buy, as does diversification. As you can see, when tech and the S&P 500 head for the pavement. Let's extend that out. Take a look at this graph. This is the high water mark of tech in the tech bubble to 2009. Once again, look at who's leading and who's getting whooped. At one point, technology lost 75% of its value from the high, so from the 2000 high. So it could be a rough ride. So first comment, it sure is a wonderful thing, and it works, especially if you're diversified and you save. Second thing, it's a rough ride sometimes. Now, let me introduce the third thing, and that is that valuations eventually matter. That is, they eventually command respect. Right now, everything is grotesquely overvalued. Not everything. The stock market, in particular technology, and in particular the S&P 500. This is a different bubble than the 2000 bubble because a lot of these names are big cap, and the tech bubble in 2000 was driven by a lot of pets.coms, a lot of small IPOs type startups that ballooned and then burst. So this one may be different. I doubt it. But there's another thing here, and that is that these bubbles, these overvaluations can go on and on and on and on. So first thing, it is a wonderful thing to invest. Second thing, it's a rough ride. Third thing, valuations matter. And fourth is You can't use tech valuation to predict anything. In fact, the fourth lesson is that predictions kind of suck. I mean, if you look at the major houses, the major Wall Street houses last year, they didn't come close to a 30% gain in the S&P 500. I don't think I reached as far as to try to predict anything, but I'm surprised at a 30% gain in the S&P 500. In fact, think about that. 1 out of every $3 is new since a year ago. That is absolutely mind-boggling. Happy days are here again. So were I to predict, I'd say the stock market tends to go up about 15%. Goes up 10% in the long-term historical average. So most years are up. So I can say the stock market's going up. I'll drink to that. On the other hand, valuations are very, very high. Valuation tells us that at some point this thing is going to bust and fall like a punctured souffle. And when that happens, fifth lesson, it will not be the end of the world, will it? Okay, let's go back to the big graph here. Let's go back to long-term returns. Take a look at this. Okay, there are about 3 stock market crashes, big stock market crashes inside that graph. There are 2 more than 50% market downsides on that thing. The lesson here is that, boy, we can recover, and if we're diversified, we have money to buy with. So we want to go into this thing diversified. Now, the downside is about once every 5 or 10 years, you get a negative 20, negative 13. This will probably be bigger because it's more of a bubble, but it certainly won't be the end of the world. So I would say my prediction is that we can't predict. In January, I'll run out Vanguard's long-term decade numbers. They've been wrong for 3 or 4 years now, maybe 5. They're as good as the bean counters can get. Now, the other option here is, let me get a drink here. The other option is that I can make a WAG, a wild approximate guess. There's another word for that, but wild approximate guess, a WAG. And that serves, Societe Generale does it all the time. Other, what's his name? Kiyoshi, who wrote Rich Man, Poor Man, he does this all the time. You make a really, really big guess. And if it comes in right, I think the guy's name was Dent. If it comes in right, man, you eat out free for the next 5 years. And unfortunately, we're actually investing, not selling books. The more realistic thing to do is to say, who the heck knows? So let's go into 2025 with a very diversified portfolio. Not be surprised if we have one of those speed bumps. Understand that it won't be the end of the world. And let's realize that forecasting really is something marketers do. So let's stay the course. Happy holidays and blessings.